In this video, we will be breaking down the strategy of supply and demand. So what is supply and demand? Supply and demand is simply aggressive buying and aggressive selling. Us retail traders, we do not have the power to affect or push price in the markets. So the only people that have the power to affect and push price in the markets is big money, which is banks, hedge funds, and big corporations, right? And us as retail traders, we want to trade when big money is in the markets. And how do we know when big money is in the markets? By identifying supply and demand. So in this chart, we see price going down, up, down, up. It's on a downtrend, down, up. Price came up back to this resistance zone, but price broke through, right? And with this strategy, you mainly want to focus on what price is doing now. You don't want to focus on what price was doing back then, right? On this downtrend, you want to focus on what price is doing in these current candles. So now what price is doing, price came up to this resistance zone. It pushed down, but rejected and pulled back, and price aggressively pushed, breaking this last high, breaking structure. And this aggressive push candle created a fair value gap, right? A fair value gap. If you don't know what's a fair value gap, go to the stage 1 of the course. You're gonna need to know what fair value gaps are in order to spot and identify high probability supply and demand trade setups. So what do we see? We see price coming up, price came down, it pulled back. We see aggressive buys, price breaking structure, breaking the previous high. So how would I know where to draw my demand or supply zones? I normally will draw my demand and supply zones right where the gap started, on the big push that broke the recent high, right? And I will put, let me zoom in real quick. I will put the bottom of the zone at the pullback, at the bottom wicks of the pullback, and then the top of the zone right where the candle began the fair value gap, right? But mind you, you want to put the zone around the area where price began to aggressively buy, but the true gap is up here at this wick. Price pulled down here and then began to buy here. So the true gap would be up here. This is where the true gap would be at. So my zone would be up there, boom. Okay, so that would be my demand zone. And the same thing for supply zones too. You want to make sure it's a black candle and then a bullish candle for your demand zones, right? And then for supply zone, you want to make sure it's a bullish candle and then a black candle coming right after, breaking structure and creating that supply setup, okay? You don't want to do a black candle and then another black candle, because that's not a supply setup and it's not a demand zone. So once we identify our zone, what are we going to do? We're going to wait for big money to push price back down to the zone so they can fill in the gap, fill in the unfilled orders, clear the gap, push price back to the zone, and let other investors or other banks, hedge funds, and corporations get in so they can continue riding the wave, right? Let's see what happens. Boom. So here, price touched our zone. Price filled in the gap, price touched our zone, and we see a little rejection right here. Even though we normally do not want price closing inside the zone, how it did here, we normally want price to come to the zone and give us a big wick and reject of the zone and give us just a big wick and close above the zone, indicating and giving us a stronger confirmation that price does not want to go down. So once I see price came down to my zone, filled in the gap, and is rejecting off my zone, I'm gonna be looking to buy. I'm gonna be looking to buy once price breaks the previous candle high, right? So right here, we have the candle high. So now if I see price open up and it breaks this candle high, the wick of the high of that candle, then I'll be getting in for buys. Now, if price continues going down and it breaks the zone, then the trade is invalid. I would just erase the zone and just go about my day and just wait for another setup to come or wait for another wave to come. Because trading is just like surfing. You don't just want to catch any wave, right, that you see. You want to catch the wave, right? You want to wait patiently for the best wave to come in order for you to ride the wave back to shore, right? You're not going to have the best surfing experience just catching any little wave, and then when the big wave comes, you missed out because you were focused on catching all these other little waves, right? So just like trading, you want to focus on high probability trade setups when they come, not focus on just any little trade setup. You want to just focus on the high probability trade setups that come. And then you want to ride the wave back to short or back to profits. And mind you, you're not going to win every trade. We have no control over the markets. I have no control whether the market goes up or down. We can only make calculated guess or a calculated prediction that will give us an edge in the markets or give us a high percentage of winning in the markets, right? So here, once I see this, I'll be looking to get in for buys at the break of this candle. And my stop loss, I will put it at the bottom of the rejection candle, right? Here is a little bit more conservative, right? Because the next candle can open, and let's say I got in the trade, one candle can easily come down and hit my stop loss, right? So it's a lower risk. So that's why it's more conservative, right? But you could also be that person that puts the stop loss at the end of the zone, at the end of the demand zone or supply zone. But mind you, if the supply zone or the demand zone is super big, like this, right? You do not want to take trades like that, where the zone is super big or your wick, your rejection candle is super big, right? Those type of trade setups you do not want to take because it's high risk. So for me on this trade setup, I would have probably put my stop loss at the bottom of the wick, low risk, and I would have put my take profit at the high, at the recent high, at the previous high, which would have been a 1-to-1, which means I'm risking $10 to make $10, right? Let's see what would have happened. Boom. Okay, here we see this next candle break the high of the previous candle. So now I would have been in the trade. Right now, I would have been inside this trade. I would have been inside this trade for a 1-to-1. See what would have happened. Boom. First candle. In 5 minutes, 10 minutes, TP would have hit 1-to-1. I would have taken my money, would have got out, set for the day. All right? So that would have been your 1-to-1 right here. Okay? Now, if you wanted to hold for a 2-to-1, which means you're holding to make $20, let's see what would have happened. Boom. Price came back down and rejected. But notice, what do you see? What do you see right here? Ignore these lines. But what do you see? You see price pushed up aggressively. Let me turn this back. Right here. Boom. So what do you see? You see price pushed up aggressively, breaking the previous high, creating a new high, and having a gap again. So this becomes another demand setup right here, from this black candle to the gap, to where the gap started. Boom. Or from the low of the pullback to where the gap started, or the big push. And now what we're gonna do, we're gonna wait for banks or price to come back down, fill in the gap, touch our zone, and we're gonna look for another break of candle or a rejection candle that confirms price doesn't want to go down, to then enter the trade and ride the wave. So let's see what happens. Boom. Right here, price hit our zone. Boom. Okay, right here, price came very deep into our zone. So when price does this, that's kind of iffy. It's like, okay, I don't know if I should take this trade. It's kind of iffy. The zone almost got broken. So if price breaks the zone, you already know, okay, this trade is invalid, because price broke the zone, it broke the demand zone. It's not respecting the zone. It don't care about the demand zone. It's doing its own thing now. So let's say if you missed out the first trade setup when the first demand zone happened, and then you missed out, and then you saw the second demand zone happen, then you could have got in right here at the break of this candle. Once you see price coming up and breaking that candle, you would have got in, and then take profit would have been the previous high, which would have been up here. All right, let's see what would have happened. Boom. TP hit. TP hit right here. Bam. Now let's say you wanted to hold for 2 to 1 to make $20, risking $10. But mind you, once take profit 1 gets hit, you want to secure profits. You want to secure some money, at least half of what you was risking, and leave the other half to see if price continue to go up and hit your other take profit. Because we don't have control what market is going to do. We don't know if market is going to continue going up. But we can only do calculated guessing, right? And we have to be present to see what price is doing and take action right there and then. So that's what we do as traders. We just react to what price is doing in the present moment. And you have to be quick. You have to think quickly, especially if you're on the lower time frame, like the 5 minute. If you're in the higher time frame, like the hour swing trading, then you don't have to think as quickly to execute these trades, right? So let's see if you would have hold if TP2 would have hit. Ooh, bam, bam. TP2 would have hit right there. So even if you missed out on the first trading opportunity, the first demand zone, you could have got in on the second one, on the second demand zone that came up and rejected and broke the candle. Now, let's say if you kept holding on that first trade, right, then you would have got in like around here, and you would have ride the wave. Oh, let me take this out. Yeah, you would have ride the wave. TP1 would have been like right here, and then TP2 would have been like around here. So you would have cleared on that too, even though price pulled back and rejected a little bit, but it's still cleared. So that's the basics of supply and demand. Now we're gonna go to another example, just so you could begin to see it more and drill it down, because you wanna be able to spot these supply and demand setups or opportunities in real time as you see price moving when you're in your session, okay? Because by the time, let's say you spot it when it's here and then it's too late, price already left, then you lost the trade, you missed out on the trade. So you wanna be able to spot them in real time. So we're gonna go over some other examples just so you can see different ideas of how they could form, how these setups could form. Because not all the time it's gonna be this clean. It's not gonna be looking this beautiful and so perfect, So let's see the other examples. So here on this example, we see price doing a little bit of uptrend, going up, down, up, down, up, down. And then we see price doing aggressive sell. Bam, breaking structure, right? It broke this structure, this low, and it created a little gap right here. Let me show you. Bam. It created a gap right here with this aggressive sell. So this will be from this bullish candle, this green candle, we'll start the gap, and it will be a supply setup. Even though price is going bullish, right? Even though price is going up, we're just looking at what price is doing now, okay? And now what price is doing, it came up, giving us a bullish trend, and then it broke this low. So now it's breaking the bullish trend. This candle right here indicates that it's breaking the bullish trend because it broke structure. It broke this low, and it created a gap, which indicates, okay, maybe sellers, maybe big banks are in the market and they're pushing price down, right? What we're gonna do, we're gonna wait for price to come back up to the zone, reject off the zone, and clear this gap. And if price breaks the zone, then that means the trade is invalid. So let's see what would have happened. Bam. Bam. The zone got cleared in just 3 candles. So sometimes it's gonna be like this. Sometimes the trade is not gonna be, or the setup is not gonna be multiple green candles and then pulling back. Sometimes it'll just be 1, 2, 3 candles and put back to the zone and continue the trade. So that's why you gotta be able to spot these in person and in real time and be able to execute them quickly in real time. Because sometimes it might be a couple candles, sometimes it might just be 1, 2, 3 candles, and the trade already happened, the setup already happened, you miss your opportunity. So you gotta be able to be quick, think quickly, spot it in real time, and take advantage right there and then. Okay, so now what would have happened here? Okay, I see this next candle and it rejected. Now what I would have did, I would have got in for sales. The next candle that breaks this recent candle's low, right, that's rejecting off the zone, I'm gonna be getting in for a sell. And I can either put my stop loss right here at the top of the rejection candle, or I could put my stop loss up here on top of the zone, which I know if the zone gets broken, the trade is invalid, right? And then I will put my take profit at a 1-to-1, which is I'm risking $10 to make $10. And let's see what would have happened. Boom. Here I would have been in the trade. I would have been inside the trade already. Because why? The next candle broke the low of the previous candle. So now I'm in the trade. And let's see what would have happened. I'm going to trade for sales. Boom. Bam. Bam. So TP1 got hit right here. If I would have hold, TP2 would have got hit. So I would have made $20 if I was risking 10. If I would have kept holding, TP3 would have got hit. I would have made $30. And if I would have kept holding, damn, TP4 would have got hit, $40. And mind you, that same amount, $40, risking $10, could have been risking $100 to make $400. It could have been risking $1,000 to make $4,000. It could have been risking $10,000 to make $40,000. So it just depends on the amount of capital and money that you have in your trading account, how much you're willing to risk. Okay, so this would have been a beautiful trade on that one candle only. You see what happened next. See what happened. Damn. Yeah, it kept going down. That would have been a nice. Let me see. Yeah, it kept going down. You would have had a 14-to-1. Risking $10 to make $140 on that one trade setup, just because you caught it at the beginning of the move. That's crazy. That would have been a crazy trade. And guess what? That's not gonna happen all the time. So if you don't expect every trade setup to go like that, because it's not gonna happen all the time. You might have a big winning day that happens like this, right? Like a 14-to-1, like maybe once a year. 2 times a year, maybe a little bit more, depending how the market is doing, that year or that month, right? But don't be surprised if you don't catch trades like that all the time, because that's not gonna happen all the time. So that's why I highly encourage you to follow your trading rules and your trading plan and stick to the 1-to-1 or 2-to-1, because we do not want the whole pie. I do not want the whole pie. I just want a slice of that pie, and I'm going home, take my money, and that's it. Okay, let's go to another example. Okay, here, what do we see? We see price going up, and then we see big bearish candles, right? Up here, it would have been a supply setup because we see a big aggressive selling, but price never came back up to the zone. So this zone is invalid. Then what do we see? Over here, what price is doing now? We see price push down, pulled back, and then push down again, breaking structure, right? Breaking this recent low, right? And creating a little gap right here. Even though this sell, even though price didn't move aggressively, it still created a gap. So that will be a supply setup. Bam. And this is the gap. You see that little gap right there? Price needs to fill that gap right here. Right? And it's a supply setup. Why? Because price broke structure. It has a gap. So it's a high probability supply setup that we could wait and see what price does to potentially catch and ride the wave for sales. Let's see what happens. Okay, here the next candle, price filled in most of the gap. Boom. Okay, next candle, that's it. The gap is filled. There's no more gap. And we see price rejecting off the zone. So that's a good candle that we like to see. Now what we're going to do, we're going to get in for sales the next candle that breaks the low of the previous rejection candle that rejected off the zone. Right, I'll put my stop loss at the top of the rejection candle. And let's see what would have happened. Boom. As soon as the candle passed, as soon as you see this candle open and it passes the bottom and it breaks the low, that's when you should be already clicking the button, getting in for sales. Okay? And then by the time this candle closed, your TP1, take profit 1, was already hit right here, 1-to-1. And then now we're just waiting for your 2-to-1 to see if it gets hit or not. So right as soon as, real quick, as soon as your 1-to-1 gets hit on your trade, you want to secure profits, okay? You don't want to leave the whole amount of money there. You want to at least secure profits because you never know what price is going to do. Price could easily hit your 1-to-1 and then shoot the opposite way and hit your stop loss and take everybody's money. So you want to make sure you secure profits when price hits your 1-to-1, or just close out your entire trade and just call it a day, okay? But if you want to maximize the most out of your trade and make the most out of that winning trade, then you will close out majority of the profits and leave a little bit of the profits running to see if price continues going higher into profit and hits your take profit too. This is TP2. Let's see what happens. Boom. TP2 would have hit. So here, I would have been set. I would have been like, okay, my take profit 1 got hit and my take profit 2 got hit. I'm set for the day. Now I'm done. I don't care what the market does. The market could continue going down. The market could do a backflip, could do a side flip. I don't care. Because I already got my daily win for the day, my daily winning percentage for the day, right? My goal for the day. I already got my goal. I'm set. I'll come back tomorrow. It's a new day, new opportunities. Because the longer, you also want to keep this in mind, the longer you stay in the charts trading, the more higher chance you have of losing money. It's just like the casino. The longer you stay playing in the machines, the more higher chance you have of the casino taking his money back or taking all your money. So it's the same thing, okay? So you want to be highly strategic with it. This is the difference between trading and gambling.